Hello, nice to see you again. Welcome to our new weekly session. Today we are going to recap what we've learned about income statement and get a brief overview of a few key financial indicators on its basis. What does income statement or P&L tells us? It provides us with an overview of the financial performance over time. That could be a month, a quarter, a year. Unlike the balance sheet, which gives us a view on a financial position at a given point in time. A typical P&L looks like this. Revenue sits on top line. Then come discounts and returns. Then we deduct cost of goods sold and get to gross profit. Next, we record personnel expenses, marketing, rent, IT costs, etc., other operating expenses. As a result, we get to operating profit. Then comes tax, and we get to net profit or a bottom line. This is P&L with the costs presented by nature. Alternatively, you can show your P&L by function, like this. Below gross profit, we record general and administrative expenses, then sales and marketing, then research and development. These functions will then include portions of different costs, for example, salaries. But the profit is not impacted by the way you present costs, it's only a matter of presentation. Now a brief recap on revenue. We have two major types of revenue. Revenue from sale of goods and revenue from sale of services. The revenue can be decreased by discounts and returns. Both directly reduce our profits. Revenue recognition has its own rules. The moment you can record revenue is normally when you transfer all the rights to the product to your customer. From that moment, it belongs to your customer. When we sell goods, we can see and touch them. Easy. Services are trickier. Them we cannot touch or physically move or separate. Normally we would agree with the customer so that they accept the services. And that would be the reason to recognize revenue. For the services which last for a longer period of time, the most common approach is to recognize revenue as you progress. It is a so-called percentage of completion approach. Now a bit of costs. In general, there are three major cost buckets. The first one, COGS or cost of sales. This is a direct cost of sold products or services, in our case, apples. The second bucket is operating expenses, also called OPEX. These are the costs necessary to run your company whether you sell apples or not. Your salary, rent, marketing, IT, etc. These expenses are also often allocated into general and administrative or G&A, sales and marketing or S&M, research and development or R&D. And the third bucket, non-cash expenses like depreciation. For example, when you buy equipment which you use over several years, you distribute the cost of this equipment over these years. And remember, accounting loves timing rules. Costs should always match revenue they relate to, a matching principle. For example, apples. When you buy them, they sit on the balance sheet as inventory. Only the moment you sell them, their cost is recorded as COGS. How does P&L interact with the balance sheet? We have learned that every transaction should have two sides, a double entry. When you sell apples for cash, you increase cash balances. If you sell apples on credit terms, you record a receivable from the customer for the same amount. When the customer pays, you swap receivables into cash. If the customer gave you a prepayment for the apples, you record it as a liability and remove the liability the moment you sold apples to the customer. The cost of goods sold is normally coming from inventory. So, when you sell apples, you take them out of inventory and move them into COGS. The net profit goes into equity. Through all of this, we ensure that everything stays in balance and nothing escapes our P&L or balance sheet unnoticed. Now, let's move forward and talk a bit about key performance indicators or KPIs, which we can get from a P&L. By deducting cost of sales from revenue, you will receive a result which is called gross profit. Gross profit shows how much you can earn by considering only the direct costs triggered by sales. When you divide gross profit by revenue, you will get to one of the most important indicators to assess businesses. This KPI is called gross margin. The higher and the more stable gross margin is, the better. For example, with revenue $100 and costs of $30, your gross profit is $70. What is the gross margin? Gross margin will be gross profit of 70 divided by revenue 100 and times 100% to get to percentages. The result is 70%. Not bad. Let's imagine that was the result for your year 1 and now you are moving to year 2. If next year your revenue is 120 and costs are 45, Your gross profit is $75. Nice, isn't it? Plus $5 to profits. But wait, what about the gross margin? Let's calculate it. Gross margin is now 75 divided by 120, which is 62.5%. That's not a good development, right? We are now earning less for every dollar of sales. This needs to be investigated. So you see, such indicators are very important to get a better picture and can signal you of any upcoming problems. After further deducting operating expenses, you will get to operating profit, and after tax, to net profit. You can now also calculate operating profit margin and net profit margin by dividing them by revenue. And then compare trends between the periods, as we did with gross margin. For example, our operating profit is $30. When divided by revenue, we get a 30% operating profit margin. With a net profit of $25, we'll get a 25% net profit margin. Again, when comparing margins across the years, we can better analyze the development of our business. To further understand the drivers of operating or net profit margins, you could dive deeper and calculate personnel expenses, marketing expenses, and other costs as percentage of revenue by dividing them by net revenue. When you have fixed costs, for example rent or personnel expenses, you would expect that when revenue is growing, the percentage of revenue is declining. That is a so-called leverage or economies of scale effect. The bigger the business, the more profit per $1 of sales you can generate. You will often hear about the scalability of a business. That is what's normally meant by it. If this is not the case, then you need to investigate why you are incurring more and more expenses to generate extra revenue. Why would you use the margins? They show a trend over time. Is our business improving? They allow us to benchmark against other companies as they represent ratios instead of absolute values. They help set prices and control costs to maintain given levels of profitability. Margins also can notify us of early signs of troubles. They can be used as assumptions to build a business plan. And last but not least, they show us how scalable our business is, whether we can increase profits by keeping costs fixed. So, with this we have finished the basics of income statement. That was a short but I hope an interesting journey. We will dive deeper into further P&L topics in our later sessions. Now, let's summarize key takeaways for the income statement. The income statement summarizes financial performance over a period of time. Income statement tracks revenue, costs and profits but no cash movement. Revenue or cost doesn't mean cash. Sale of goods is recognized when ownership is transferred, sale of services when services are accepted or progress is made. Prepayments are not revenue. They are recorded as a liability until the goods or services are delivered. Costs should always match the revenue, a matching principle. On the basis of a P&L, a number of important KPIs are generated, for example gross margin, which help assess the health of businesses. Thanks for your attention. That was your income statement recap and KPI starter kit. Next week we'll start with the basics of cash flow, the third important financial report for any business. Don't forget to like and subscribe for more lessons on accounting and finance. See you next week.